Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Fluence Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here's a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So, diving right in, it is incredibly easy to get swept up in a massive 51% single-day move, like the one we saw on June 1st, 2026.
Oh, absolutely. I mean, it was explosive.
Right. And as an analyst, my immediate instinct when I see a move that aggressive is, well, skepticism. But the spark here was this newly announced AI factory partnership with Siemens and NVIDIA.
Yeah, and when you look beneath the surface of that, wild price action, you find a very serious conversation about the actual physical limits of our infrastructure.
Exactly. You hear all about the software side, right? The language models, the algorithms, but you don't hear nearly enough about the sheer amount of electricity required to run them.
Which is why this partnership is so critical. This isn't just, two tech companies swapping logos for a quick press release. It's a direct engineered bridge connecting heavy energy storage with next-gen data centers.
Right.
You literally cannot build the AI revolution without the heavy industrial infrastructure to power it. And the market is finally waking up and pricing that in.
All right, let's move into the wealth building context, because we really have to separate a one-day trading event from an actual, long-term thesis.
Right, and to do that, you have to understand the structural shift happening here. For years, the market viewed Fluence purely as a renewable storage play, like just giant batteries sitting next to solar panels.
Yeah, waiting for the sun to go down.
Exactly. But that old narrative is dead. What you're seeing now is the market aggressively repricing them as an essential, unpriced AI power mode. They are solving the data center power deficit.
And that deficit is not just some short-term blip. I mean, generative AI requires exponentially more power than traditional cloud computing. The big hyperscalers, the Amazons, the Googles are desperate for grid stability.
Because if a data center loses power for even a fraction of a second, those compute cycles are totally ruined. So they are staring down this massive multi-year build-out, and Fluence provides the exact physical battery infrastructure to balance that load.
And looking at this as a multi-year build-out is so critical for your portfolio. When a stock pops 51%, the retail instinct is to chase the momentum or just give up because you assume you missed the boat.
Yeah, both are usually huge mistakes.
Right. You have to look at this through a 3 to 5 year hold horizon. You aren't trying to catch a single-day spike. You're trying to align your capital with these unavoidable secular tailwinds like the entire grid transitioning.
Exactly. It's about compounding growth over half a decade by positioning yourself with the gatekeeper of that power stability.
Well said.
Now let's look at the fundamentals. Because a narrative is just a story unless you have the financial strength to back it up.
Right. And the numbers we pulled from their filings are actually staggering.
They really are. I mean, explosive top-line growth. In their fiscal year 2025, revenue hit $3.8 billion. That is a 38% year-over-year increase.
Which is great. But, a lot of companies can grow revenue if they bleed cash to do it. Selling dollar bills for 90 cents will always boost your top line. What really mitigates the risk for me is their backlog.
Oh, the backlog is massive. They hit an all-time high contracted backlog of $5.2 billion.
But let me push back on that for a second. Is that backlog actually ironclad? Like, if the economy slows down, Can these tech giants just cancel their orders?
Well, no, that's the beauty of utility-scale infrastructure. These aren't soft commitments or refundable pre-orders. They're heavily contracted agreements extending well into 2027, backed by massive utility balance sheets.
Right, so breaking them carries severe penalties.
Exactly. And because of that visibility, they just raised their forward guidance for fiscal 2026 to between $4.4 and $4.7 billion.
Okay, so the revenue's protected. But what about profitability? Because that's where I was most surprised. We're seeing a total shift from the growth at all costs cash burn of their early years.
Yeah, they've really turned a corner. Gross margins expanded to 18.5%, and they generated $115 million in positive free cash flow.
And when you look at their balance sheet, it is a fortress. They're sitting on $820 million in cash against just $130 million in debt.
Which is mostly just low-interest equipment financing anyway.
Right, so having nearly $1 billion in cash gives them immense downside protection. But I do have to ask the obvious question. Without the AI hype, isn't Fluence ultimately just assembling batteries? Aren't hardware assemblers incredibly vulnerable to cheap overseas competition?
That is the exact misunderstanding that kept the stock mispriced for so long. They are absolutely not just a hardware assembler. Their economic moat is built on two pillars. First, their parentage.
Being a joint venture between Siemens and AES.
Exactly. That gives them unmatched global procurement power and instant bulletproof credibility for massive utility contracts.
And the second pillar, I'm guessing it's the software.
Yes. Their proprietary AI-driven energy management software, Mosaic. You just can't run a complex modern grid with dumb batteries.
Yeah.
You need incredibly sophisticated algorithms to optimize everything in real time.
Right, Mosaic predicts peak demand, buys cheap power, and deploys it when the grid is strained. It's their ultimate defense against pure-play hardware competitors. I like to use a biological analogy for this. If the batteries are the physical muscle and bone of the grid, integrating Mosaic into a utility is like installing a completely new nervous system.
Oh, I love that analogy.
Right, because once it's embedded, it controls everything. The switching costs become astronomically high. You don't rip out the brain of your power grid just to save a few pennies on a cheaper piece of hardware.
The software makes the hardware sticky.
That brings us to the catalyst timeline. Because when you have fundamentals this strong, you want to know what's going to actually drive the stock in the next few months.
Well, the most immediate event is the highly anticipated Q3 2026 earnings report coming in late September. Analysts have already revised their EPS estimates upward by 22%.
That's a massive adjustment for Wall Street to make in just 90 days.
It is. But before that, we're looking at their presentation at the AI and Data Center Energy Summit in August. They're going to showcase exactly how these NVIDIA synergies are being deployed.
Right, literally mapping out the technical architecture for the whole industry. But to really understand the timeline, you also have to grasp the macro catalysts, like grid interconnection queues.
Yeah, the wait times to get on the public grid are crazy right now.
Exactly. It's like a massive traffic jam at a single toll booth.
Yeah.
That bottleneck makes behind-the-meter battery storage a physical necessity for these data centers.
And for anyone unfamiliar, behind the meter just means the storage sits right on the customer's property, literally next to the data center. It's like a VIT fast lane that bypasses the public grid wait times entirely.
Plus, if we see potential Fed rate cuts later in 2026, that is massive for them. Infrastructure projects need huge upfront capital, so cheaper borrowing lowers the discount rate.
Right. The future payoffs of these long-duration projects become much more valuable today. When borrowing costs drop, their order book accelerates.
Exactly.
Now let's pivot to the chart, because we need to look at how these catalysts are physically manifesting in the price action right now.
And, I mean, the momentum is just overwhelming.
It really is. A 51% surge on record volume means it violently broke above all previous resistance levels. It's in a pure price discovery phase now.
Let's explain what that actually means for the listener.
Sure. When a stock breaks past its all-time highs like this, there's no historical ceiling where old investors are waiting to sell and break even. The market is basically blindly feeling around in the dark to figure out what the new fair value is.
Right, but I have to inject a crucial warning here about the mechanics of this move. Yes, institutional accumulation, big funds buying in is absolutely happening. But this move was heavily fueled by a violent short squeeze.
Which is incredibly important to understand.
Right. Traders betting against the stock were suddenly facing infinite losses on that NVIDIA news. They had to panic buy to close their positions, which acted like gasoline on a fire.
A massive feedback loop.
Exactly. As an investor, you have to be prepared for extreme volatility. The dust hasn't settled, and the price action is going to remain chaotic as the market finds equilibrium.
Right.
So what does market sentiment look like, beyond just the raw price action, I mean?
Well, unsurprisingly, it's firmly bullish. Analysts are issuing upgrades to strong buy, and the media is totally embracing this unpriced AI power moat narrative.
But there's also some whisper network chatter happening, right?
Oh, tons. There's unconfirmed M&A chatter bubbling up, rumors that Siemens might buy out AES's stake entirely, or that a hyperscaler might just acquire Fluence outright to vertically integrate their power supply.
Look, I always caution investors to temper their excitement on M&A rumors. You should never, ever build an investment thesis purely on the hope of a buyout.
Right, because if it doesn't happen, you're left holding the bag.
Exactly. It's speculation, not analysis. But we can rely on institutional filings. The Q1 2026 13F filings are going to show massive whale accumulation.
The smart money is definitely positioning themselves.
And what's really telling is that they're entirely ignoring the negative political rhetoric right now, focusing purely on private sector demand.
But if the broader market is shrugging off the noise, we still have to ask what happens if the business itself stumbles. Now let's talk about the risks.
Because no investment is without a bear case. The first major risk is execution. The market has priced in a tremendous amount of optimism on this NVIDIA partnership.
Right. And if they underdeliver or timelines slip, that elevated short interest means the stock could suffer a violent reversal.
The higher you fly on expectations, the harder you fall on delays. Second, we can't ignore political headwinds. The Green New Scam rhetoric carries an implicit threat to roll back Inflation Reduction Act subsidies.
Those are valid concerns, but the mitigations are strong. That 51% breakout likely forced a massive percentage of shorts to cover entirely, which establishes a much higher permanent cost basis. The floor has been raised.
And what about the political risk?
This is the most crucial point. Hyperscaler AI demand is a pure economic imperative. This is private money flowing from the biggest tech companies in the world because they literally have to build these data centers to survive.
So they aren't completely reliant on government subsidies.
Exactly. They're insulated, backed by the most urgent, well-funded private capital expenditure cycle in history.
So with everything on the table, what's the final verdict?
Synthesizing the fortress financials, the catalysts, and the shifting narrative, we arrive at a bullish score of 9 out of 10.
That's a strong conviction.
It is. The elevator pitch is clear. Fluence Energy is the premier pick-and-shovel play on the AI power deficit. Sticky software moats, $1 billion in cash, and the Siemens-NVIDIA partnership. The target horizon is a multi-year hold.
I completely agree with the thesis, but I want to leave you with one final provocative thought. We spent this entire time talking about battery storage for the public grid. But what if these tech giants decide the grid is just too unreliable altogether?
Oh, like building their own micronuclear power plant?
Exactly.
Yeah.
Small modular nuclear reactors right next to the data centers. If they bypass the public grid entirely in the next decade, does the demand for utility-scale batteries dry up? Or do those nuclear sites need massive battery buffers too?
It's a fascinating question about the future of energy architecture.
It really is.
Yeah.
And while this multi-year revenue ramp is undeniably compelling today, remember to size your positions carefully. The ongoing volatility from short sellers means there will be turbulence along the way.
Absolutely.
If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.